Hi, I'm Peter Royster with the Royster Real Estate Group, and we want to welcome you to one of many videos we're going to start doing on the top 10 questions that you may have relating to real estate. And so today we're going to do top 10 questions of why to get pre-approved. And so with us today, we have with us, his name is Matt Brown. Matt Brown with Encompass Lending, just joking.
Good morning.
And we appreciate Matt coming out.
Great.
And so we wanted to put together, like I say, top 10 questions of what people may have and kind of why should they get pre-approved.
Yep.
And so obviously that's the first question is what's
Yep.
the benefits, what's the concerns?
Well, in this market, as we all know, this is a very, very busy market. To be pre-approved gives you a leg up on the competition. So
especially today.
So really for us, we reach out immediately. We want to take a look at credit, calculate debt to income ratios. We're going to know as we get started which direction we're heading in. So it's just important because if you try to make an offer on a property, they're going to want to make sure you've done your homework.
Yeah, and I think the other big key is Vicki and I get asked a lot of times, what can I get pre-approved for? And they usually tend to think about the number as in price of the house. And the truth is what we're looking for is what is your payment?
Yep.
A lot of things go into that payment part.
Yep.
So how much they're going to put down, different things like that.
Yep.
Yes, interest rate is important, but we're at crazy low interest rates to start with right now.
Right.
But y'all are able to help work them through every bit of that part.
Right.
You can tell them every piece.
Right. And one of the things I would also kind of talk about as far as getting the pre-approval letter, because we get asked this all the time.
Okay.
Let's say we have somebody pre-approved for $300,000 and they're trying to make an offer at $250,000. We don't necessarily want to put a letter out there at $300,000 if they're trying to offer $250,000 because if the seller thinks they can afford more, they're going to be less likely to want to negotiate. So we like to make those pre-approval letters address and price specific.
Absolutely.
So we don't show our cards.
Absolutely, and very helpful.
Yeah.
So in terms of what type of loans that are out there, give us a quick little synopsis of what's the difference and why should somebody go with a particular loan?
Sure. So the three main loans that we see every day is either conventional, FHA, or VA. Okay. So I look at I've been doing this long enough to know what loan type's going to be best for somebody. We look at credit score, we look at debt to income ratio, we look at assets, what they have to work with, and there is a better loan type given their situation.
Yeah, and so usually if somebody's wanting to put the least amount down, in a lot of cases they're going FHA, unless they were a part of the military and could do VA.
Yeah, so if you're VA, it's zero down with no mortgage insurance. That's a big deal. The VA is the sweetest loan going, but not everybody qualifies for the VA. So you've got FHA, which is typically steers towards a person with lower down payment, 3.5% down, typically credit scores 680 and below, 670 and below, kind of in that, because you can get better interest rates and a lower payment for that person. Because on a conventional loan, the lower the credit score, the higher the interest rate. And we see that. And so, but on a conventional, there's first-time homebuyer programs at 3% down. So that's a great loan too.
And so I think the key is you're going to be able to tell them based on what you're saying, hey, this is the best direction to go.
Most definitely.
So everybody asks the question, because you always hear interest rate, but you also hear APR, annual percentage rate.
Right.
So tell us the difference.
Yeah, APR it's a disclosure rate. Yeah. So it's APR, the annual percentage rate. It's the interest rate that you're really paying for that loan for the first year only when you calculate it on the closing cost that it took to do it. So obviously, a competitor that might have higher closing costs is going to have a higher APR. But really, when shopping for these loans, it's what's my interest rate and what's it costing me to get this rate. Yeah. So every mortgage company has a different semantics on what they call an underwriting fee versus a processing fee versus an attorney fee versus an admin fee. So, but at the end of the day, how much am I paying? What's my estimated cash to close, and what's my interest rate?
Yep, absolutely.
So that's really what as you're shopping, that's the best thing to do.
And then number 4, debt to income ratio. And this is something that I think a lot of people don't realize, again, has some moving parts with it too.
It does. So the debt to income ratio is comprised of two different a top ratio and a bottom ratio. Yeah. The top ratio is what's called a housing ratio. Yeah. It's important.
Everything. Yeah.
The bottom one does. The housing, it's your projected house payment divided into your gross monthly income. Okay. We like that to be about 40%. Okay. That's the top ratio. That's the housing. The bottom ratio is called your total expense ratio. Yeah. Okay. So it's your projected house payment plus everything that's going to be showing up on your credit report as a minimum monthly payment. Yep. Okay. So we take that total monthly divided into your gross, and that creates your total expense ratio for the bottom. So it's a top and a bottom. We like to see that 45 to 50%.
Okay.
So on FHA allows for a little bit higher debt to income ratios. You can actually take that up to 56.99.
Okay.
So but really conventional, no more than 50. And that's if you have great credit scores.
And don't forget, don't worry, you're not going to have to remember all those numbers. You call Matt,
right,
and he works you through all those. So we talk about, a lot of folks know that if you get to this magic number of 20% down,
right,
it's this beautiful magic number. Why?
Right. So 20% down, everybody pays PMI unless you're a veteran.
Which is
a
private mortgage insurance.
Private mortgage insurance. Yeah. Private mortgage insurance protects the lender in case you default on the loan.
Yeah.
There's no advantage to having PMI.
Yeah.
It only protects the lender. So the key is to try to get out of that as soon as you can.
Yeah, absolutely.
So and that's the 20% equity. Yeah. Equity is the difference between what your balance is and what your house will appraise for. That's the 20% equity. Mm-hmm. On a conventional loan, PMI drops off after 20%.
Yeah.
On an FHA loan, it never
drops off anymore.
It's on for life.
That's right. So. And keep in mind, once you get to that point, we would be working with you on that. Matt would too also, but you actually typically want to make sure you're asking for the 20 or the PMI to be taken off, because a lot of times it doesn't automatically come off as easy as you think.
That's right.
Anyway,
yeah. So people always challenge that. Sure.
So number 6 is, are there minimum credit scores that are either for each loan type or just different things like that?
Yeah. So for conventional, the lowest score in the whole industry is a 620. You cannot get a conventional loan under 620. Okay. So and conventional does what's called risk-based pricing, like I was referring to before. Okay. The lower your credit score, the higher the interest rate.
That's right.
It just is what it is. So typically you're going to get your best scores on a conventional loan with 740 and above.
Okay.
And then from 720 to 739 there's an adjustment. 700 to 719 is an adjustment. 680 to 699. So the further you go down, the higher adjustment you're going to take.
It's a tiered process.
It is. It is. Now on FHA, the lowest we can go is a 620 on an FHA. We used to be able to go to a 600 and even to a 580. Yeah. But with COVID, a lot of these lenders, they're taking risk off the table. There's only a couple guys that I associate with in the entire city that can go to a 600 or even a 580. So there's some out there, but it's risky.
And the thing is, that affects everything. If you think about it, it's affecting your insurance for cars. Yes. I mean, they all look at every bit of this. So your credit score is really important.
Yeah, and I've said this for years. I mean, credit score is more important than having money.
Yeah,
I have people all the time that may have $500,000 in the bank, and it doesn't mean anything because the lender has no access to it.
Yeah, and just real quick, the big key on your credit score is pay your bills. So number 7, what cost or fee will be required to pay prior to closing?
Right. So the only thing you have to pay up front with us is the appraisal.
Yep.
He's the only person in the process that's not willing to wait to closing to get his monies.
Yep.
It may bust out for whatever case.
And that's the reason why. Is unfortunately, if it doesn't work, he's still doing his job all that kind of, he or she, excuse me.
Right.
So number 8, do you charge for a mortgage rate lock?
No, and a lot of companies do. We don't. So, we're in it together. We don't charge. You get your best rate 30 days prior to closing. Okay. The further you lock out, 45, 60, 90, 120, 180, the further you lock out, the higher the rate, because the bank's only willing to hedge for a certain period of time.
Yep.
A big thing can happen. 9/11, the freeze, a terrorist attack. I mean, something that could drastically affect the market.
Okay.
Yeah.
Number 9, is there a prepayment penalty on loans? Is that even on any of them, or is it just, I thought pretty much they've gotten rid of that a while ago.
They did. But I will tell you, and I'll share this with you just from a broker/banker world, there's no prepayments to the borrower.
Okay.
But for us, there's typically 180 days, because if that loan pays off or refi or whatever, the lender will come back to us and ask us to reimburse our commission, because they haven't had that loan long enough to offset the cost of having paid me to bring their business to them.
Okay.
But there's no borrowers.
But to the borrower, there is not.
If they wanted to pay off, we tell them no prepayment.
And that's nice, because there used to be. I've done this 17 years, and I don't think I've seen it in that length of time.
Right.
So, and last, number 10, yay! How long will it take for from application to closing time? What's the typical time frame? Now there can be different things that come into play, and the most important one is, if they ask you for information, get it to them.
Right.
But what's the typical time frame?
For purchases right now, we're 30 days. We've always been 30. So I think last year I averaged like 26 days start to finish. Okay. But again, this is like you were saying, it takes a village to get this done.
Absolutely.
There's literally, we counted one time, there's 28 to 30 people that will actually touch this loan,
Yeah.
from appraisers to underwriters to processors to
Yeah.
surveyors to title companies.
Yep.
So it's, it's our job to keep everybody on task every day.
Yep.
So, but right now appraisals are taking longer. I mean,
Yeah.
appraisals are taking 10, 12, 14 days in some cases. So
Yeah.
we need everything to happen. Now, on a refi, we're in a big refi boom right now because rates are near all-time lows still, and refis are taking anywhere from 50 to 70 days right now. They just are.
So the big key is, again, just on that point, when they ask you to get something to them today, get it to them yesterday, as we always say. Well, hey, we want to thank you for coming out.
Thanks, Peter.
And to get some good information to you. We hope this was helpful for y'all. Again, Peter and Vicki Royster with the Royster Real Estate Group, Matt Brown with Encompass Lending. We're going to put some information at the end so you can get in touch with us, and we'd love to earn your business.
Great. Thank you.
Thanks for watching.